Have you ever looked at someone who's financially successful and thought, how did they get so far ahead? Not because they won the lottery, not because they started a billion-dollar company, just somehow. While you feel like you're working just as hard, saving when you can, trying to make smart financial decisions, and yet it still feels like you're running to stay in the same place. Here's what's strange. Most people think wealth is built through a few big decisions, buying the right stock, timing the market. But when you study people who've quietly built lasting wealth over decades, you start noticing something completely different. Their biggest advantage wasn't making one brilliant decision. It was making hundreds of small decisions that kept working long after they forgot about them. That's the part almost nobody sees, because compounding is invisible at first. For months, sometimes even years, it feels like nothing is happening. You save, you invest, you wait, and the results barely seem worth the effort. That's why so many people quit, not because compounding doesn't work, but because it works too slowly to impress impatient people. Then something unexpected happens. The same force that once looked insignificant begins to move faster. Small gains become meaningful. Meaningful gains become life-changing. Financial researchers often point out that most of the growth in a long-term investment happens in the final stretch of the time it's invested, not the beginning. And suddenly, people looking from the outside call it luck, when in reality, they missed the years when nothing exciting seemed to be happening. That's the biggest misunderstanding about compounding. It isn't a shortcut to wealth. It's the reward for staying consistent long enough to let time do what people can't. By the end of this video, you'll understand the laws of compounding, not as formulas or financial jargon, but as practical principles that quietly shape every dollar you earn, every decision you make, and ultimately, the life you're able to build. And the very first law explains why most people give up just before compounding is finally about to work in their favor. Chapter 1. The biggest lie we believe about wealth. If there's one reason most people never experience the true power of compounding, it's because they expect it to look exciting. Think about almost every success story you've ever seen. A startup becomes worth billions. Someone retires early. An investor suddenly becomes a millionaire. From the outside, it all looks like it happened overnight. But that's rarely how it actually happened. What you're seeing is the result, not the years that created it. Compounding has a frustrating habit. It hides its progress. Imagine planting a tree. You water it, protect it, take care of it every single day. A week goes by, nothing. A month goes by, still nothing impressive. Even after a year, it may not look dramatically different. If you judged the tree only by what you could see, you probably stop watering it. But underneath the surface, something far more important is happening. The roots are growing. And without strong roots, there will never be a strong tree. Money works in a surprisingly similar way. The first few years often feel disappointing. You invest consistently, you avoid unnecessary debt, you reinvest your returns, yet your account barely seems to move. That's the stage where most people give up, not because the strategy failed, but because they mistake slow progress for no progress. Psychologists have a name for this. Humans naturally prefer immediate rewards over larger future rewards. It's one reason saving money feels difficult, while spending it feels effortless. Your brain values what it can enjoy today far more than what it might gain 10 years from now. And the market quietly takes advantage of that impatience. Every time someone abandons a long-term investment because it's not doing anything, compounding resets. Every time someone jumps into the latest trend hoping for quick gains, compounding gets interrupted. Every time someone cashes out too early, time loses another chance to do the heavy lifting. That's why Warren Buffett has never treated time as something to fight against. He treats it as his greatest business partner. In one of his shareholder letters, Buffett explained that wealth isn't built by constantly making brilliant moves. It's built by allowing good decisions to keep working for years. That sounds simple, but it's incredibly difficult in a world that rewards instant results. Social media celebrates overnight success. Financial headlines celebrate the stock that's up 40% this month. Friends talk about quick wins. Almost nobody talks about the investor who quietly bought quality businesses, kept investing month after month, ignored the noise, and let 20 years do the work. Yet history shows that's how much of lasting wealth has actually been built. This brings us to the first law of compounding. The first law of compounding: time matters more than timing. Most investors spend their lives trying to find the perfect moment to invest. They wait for the next market crash, the next interest rate decision, the next election, the next prediction. But the biggest returns rarely come from perfect timing. They come from giving your investments enough time to grow. Because every year you stay invested doesn't just add another year's return, it gives all your previous returns another chance to grow as well. That's when compounding begins to accelerate. Slowly at first, then almost unbelievably fast. But there's one question that still remains. If time is the greatest advantage an investor has, why do so many intelligent people still struggle to benefit from it? The answer has nothing to do with money. It has everything to do with human behavior.
Chapter 2. Your biggest enemy isn't the market. If time is the greatest advantage an investor has, why do so many people still fail to benefit from it? The answer is surprisingly simple. Because compounding doesn't break when the market falls. It breaks when people do. Think back to the last time the market dropped sharply. For a few days, every headline sounded the same. Stocks are crashing, investors are panicking, billions wiped out. Even if you knew markets had recovered from every major downturn in modern history, those headlines still made you uncomfortable. That's not because you're irrational, it's because your brain is doing exactly what it evolved to do: protect you from danger. Thousands of years ago, reacting quickly to danger increased your chances of survival. In today's financial world, that same instinct often pushes people to make their worst investing decisions. When prices fall, fear tells you to sell. When prices rise quickly, greed tells you to buy. By the time confidence returns, the opportunity is often gone. This cycle repeats itself over and over. Not because markets change, but because human nature doesn't. That's why one of Warren Buffett's most famous quotes still feels just as relevant today. Be fearful when others are greedy, and greedy when others are fearful. It's a simple sentence, but living by it is incredibly difficult. Imagine investing consistently for 5 years. Then the market suddenly falls by 30%. Your portfolio shrinks. The news turns negative. Friends start saying, "I'm waiting until things get better." At that moment, 2 investors are created. The first investor stops investing. He waits for certainty. The second investor keeps following the same plan, month after month, ignoring the noise. A few years later, the market recovers. Historically, broad U.S. markets have recovered from major declines over time, although the timing has varied and future performance is never guaranteed. The first investor finally feels confident enough to come back. The second investor never left. Both experienced the same market, but only one allowed compounding to continue uninterrupted. That's the hidden cost of emotional investing. People often believe they lose money because they chose the wrong investment. In reality, many lose money because they abandoned the right investment at the wrong time. That's why successful investing is rarely a test of intelligence. It's a test of consistency. The market rewards the investor who can keep making reasonable decisions, especially when those decisions feel uncomfortable. That's the second law of compounding. The second law of compounding? Consistency beats intensity. You don't need one extraordinary year. You need many ordinary years connected together without interruption. Small investments, repeated consistently, often outperform brilliant decisions followed by emotional mistakes. Because every time you stay consistent, you're giving compounding another chance to do what it does best: build on yesterday's progress. But consistency alone isn't enough. There's another force quietly multiplying your wealth in the background, and most people underestimate it for decades. Once you understand that force, you'll never look at a dividend, an interest payment, or an investment gain the same way again. Chapter 3. The money that starts working for you. Imagine hiring the perfect employee. They never ask for a raise, they never take a vacation, They work every single day, and instead of asking you for money, they keep bringing you more. That's exactly what happens when you stop spending your investment returns and start reinvesting them. Most people think compounding works because their investments grow. That's only part of the story. The real magic begins when yesterday's returns start generating tomorrow's returns. That's when money begins working for money. Think about it this way. Imagine you invest $100. After some time, it grows to $110. Many people see that extra $10 as a reward. They spend it. They celebrate it. And without realizing it, they've ended the compounding process before it had a chance to become powerful. Now imagine someone else does something different. Instead of spending that $10, they leave it invested. The next return isn't earned on $100 anymore. It's earned on $110. Later, it's earned on $120, then $130. Eventually, you're no longer growing just your original investment. You're growing years of accumulated growth. That's why compounding feels slow in the beginning. The early gains look almost insignificant, but every dollar you leave invested becomes another worker inside your financial system. Over time, those workers begin creating even more workers. This is one of the reasons Warren Buffett has often praised businesses that can reinvest their earnings at high rates of return. A company that earns profits is valuable, but a company that can repeatedly reinvest those profits into opportunities that create even more profits becomes exponentially more valuable over long periods. The same principle applies to individual investors. Every dividend you automatically reinvest, every interest payment you leave untouched, every gain you resist spending, adds another layer to the compounding engine. Unfortunately, human psychology pushes us in the opposite direction. We love immediate rewards. Receiving a dividend or seeing an investment gain creates a feeling that we've earned something. Our first instinct is to enjoy it, buy something, celebrate, reward ourselves. There's nothing wrong with enjoying your money, but there's a cost that most people never calculate. Every dollar spent today is a dollar that can no longer compound for years to come. And, unlike ordinary expenses, that lost compounding can never be recovered. Time only moves in one direction. This is why many wealthy investors focus less on asking, "How much did I make this year?" and more on asking, "How much of today's gain can continue working for me tomorrow?" That simple shift changes everything. Because once your returns begin producing their own returns, growth no longer depends entirely on how much you personally contribute. Your existing wealth starts helping create future wealth. That's the third law of compounding. The third law of compounding? Reinvest before you reward yourself. The goal isn't just to make money. The goal is to keep your money employed for as long as possible. Because the longer it stays invested, the harder it works. But there's another mistake that quietly destroys compounding, even for people who consistently invest and faithfully reinvest their returns. It's a mistake so common that millions of investors make it every single year without realizing how much it's costing them. And unlike market crashes, this one is completely on. Chapter 4, The Silent Killer of Compounding. Imagine climbing a mountain. Every day you take 10 steps forward. It doesn't feel like much, but after months of consistency, you've climbed farther than you ever imagined. Now imagine that every few days, you accidentally slide 5 steps backward. You're still moving. You're still putting in effort. But reaching the top suddenly takes much longer. That's exactly how compounding works. People spend years looking for investments that earn an extra 1 or 2%. At the same time, they ignore the habits quietly pulling them backward. High investment fees, frequent trading, emotional decisions, selling too early, buying too late, unnecessary taxes from constant buying and selling. Individually, none of these mistakes seem catastrophic, but compounding doesn't see them as one-time events. It sees them as permanent interruptions. And over decades, small interruptions become enormous differences. Warren Buffett has often reminded investors of one simple truth. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Of course, Buffett doesn't mean you'll never experience a temporary decline. Every investor does. Even Berkshire Hathaway has gone through difficult periods.
What Buffett is warning against is something much more dangerous: permanent losses caused by poor decisions. There's a big difference between a business temporarily becoming less valuable and paying far too much for a weak business, or taking risks you don't fully understand. One is part of investing. The other is avoidable. This is where many investors unknowingly fight against compounding. Imagine investor A earns an average return of 10% a year. Investor B earns 10% too. But every year, frequent trading, unnecessary costs, and emotional mistakes quietly reduce those returns. The difference doesn't seem dramatic after 1 year, or even 3, but stretch that over 20 or 30 years, and the gap becomes enormous. Not because one investor discovered a secret investment, but because one allowed more of their returns to stay invested. That's one of the biggest misconceptions about wealth. People think becoming richer is only about making more money. In reality, it's often about keeping more of the money your investments have already earned. Great investors understand this instinctively. They don't just ask, "How can I increase my returns?" They also ask, "What is quietly reducing them?" That question changes everything. Because every unnecessary cost, every emotional trade, every avoidable mistake doesn't just reduce today's return. It reduces the amount that can compound tomorrow. And tomorrow's return is what eventually creates real wealth. That's the fourth law of compounding. The fourth law of compounding: protect your downside before chasing more upside. The goal isn't to win every year. The goal is to avoid the mistakes that permanently interrupt decades of growth. Because compounding doesn't demand perfection. It rewards consistency, and it punishes unnecessary interruptions. But even investors who avoid major mistakes often overlook one final principle. A principle that explains why two people can earn similar returns, yet one quietly builds far more wealth than the other. And once you understand it, you'll never measure financial progress the same way again. Chapter 5. The most valuable asset you can never buy back. By now, you've probably noticed something. None of the laws we've talked about promised a shortcut. None of them relied on predicting the market. And none of them required finding the next million-dollar stock. They all pointed to one thing: giving compounding enough time to do what it does best. Which brings us to perhaps the most important law of all. Your greatest investment isn't your money, it's your time. Think about two investors. Not because one is smarter than the other, but because they start at different moments in life. The first person begins investing at 25. The second waits until 35. Both earn similar returns. Both invest consistently. Both make intelligent decisions. The only real difference is 10 years. Most people assume the second investor can simply invest a little more later and catch up. Sometimes they can reduce the gap, but what they can't replace is the lost time. Because compounding doesn't grow in a straight line. It grows on top of everything that came before it. Those early years aren't valuable because the account becomes huge overnight. They're valuable because every future year builds on them. It's like rolling a snowball down a hill. At first, it barely changes. Then it starts picking up more snow. Eventually, it becomes so large that every rotation adds more than the previous one. If you stop the snowball halfway down the hill, you don't just lose today's progress. You lose everything it could have collected afterward. That's exactly what happens when people delay investing year after year. They often say, "I'll start when I earn more. I'll start after I pay off everything. I'll start when the market feels safer." Those reasons sound reasonable, but the calendar keeps moving anyway. And compounding quietly rewards the person who started with less long before it rewards the person who waited for the perfect moment. That doesn't mean you should invest money you can't afford to invest, or ignore high-interest debt. It means you shouldn't confuse waiting for perfection with making progress. One small investment today often teaches more than another year of planning. That's why Warren Buffett has repeatedly emphasized that the best investment you can make is in yourself. Learning better financial habits early creates benefits that continue compounding for decades. Knowledge compounds. Skills compound. Good habits compound. Strong relationships compound. And of course, money compounds too. The people who build lasting wealth rarely rely on one extraordinary decision. They simply allow dozens of good decisions to keep working together for years. That's the fifth law of compounding. The fifth law of compounding: the earlier you begin, the less you have to rely on perfection. You don't need to invest enormous amounts from day one. You don't need to predict the next market winner. You don't need to beat everyone else. You simply need to start, stay consistent, and give time the opportunity to multiply the decisions you're making today. Because once you truly understand compounding, you stop chasing fast results. You stop comparing yourself to everyone else, and you begin playing a completely different game. A game where patience becomes an advantage, consistency becomes a superpower, and time becomes your greatest financial partner. But before we finish, there's one final realization that connects every law we've covered and explains why compounding is about far more than just money. Final chapter: the real meaning of compounding. By now, you might have noticed something. This video was never really about doubling your money. That was only the beginning. Because once you understand compounding, you start seeing it everywhere. Every workout compounds. Every book compounds. Every skill compounds. Every relationship compounds. And every financial decision compounds. The challenge is that compounding is invisible while it's happening. That's why most people underestimate it. They judge today's effort by today's results, not by what those results will become 5, 10, or 20 years from now. Think about Warren Buffett for a moment. People often look at his net worth and assume it came from extraordinary investments. The investments mattered, but what mattered even more was how long those investments were allowed to grow. Buffett started investing as a child and stayed committed to the same principles for decades. His wealth didn't appear because of one brilliant year. It was the result of thousands of ordinary decisions repeated consistently over an extraordinary amount of time. That's the part people rarely notice. We admire the outcome, we ignore the process. And that's exactly why so many people struggle to build wealth. They're searching for a shortcut, while compounding quietly rewards consistency. Let's step back and look at the laws we've uncovered. Time matters more than perfect timing. Consistency beats intensity. Reinvest before you reward yourself. Protect your downside before chasing more upside. Start early because time is an asset you can never buy back. None of those ideas are complicated, but together they create something incredibly powerful. Because compounding isn't driven by one spectacular decision. It's driven by thousands of ordinary decisions that support each other over time. The truth is, most people don't fail because they lack opportunity. They fail because they interrupt their own compounding. They stop investing after a market decline. They spend money that could have remained invested. They chase trends instead of following a plan. They wait for the perfect moment that never arrives. Every interruption slows the process. Every consistent decision strengthens it. And that's why the people who build lasting wealth often look ordinary while they're building it. Their lives don't always appear exciting. Their progress doesn't always make headlines. But year after year, decision after decision, their financial foundation quietly becomes stronger. One day, people look at the result and call them lucky. They weren't lucky. They simply stayed committed long enough for compounding to become visible. So if there's one idea worth remembering after this video, let it be this. Compounding isn't a secret reserved for millionaires. It's a process available to anyone willing to think long-term. You don't need to predict the market. You don't need to find the next viral stock. You don't need to be the smartest investor in the room. You need a plan. You need patience. And most importantly, you need the discipline to keep going when progress feels too small to matter. Because one day, the small decisions you're making today won't look small anymore. They'll become the financial life you're living. And that's the real power of compounding. It doesn't just double your money. Over time, it quietly changes what's possible.